This is Chapter 14, Section 1, How Taxes Work. As we get through today's information, I recommend that you take notes so you'll have that information for the check for understanding at the end of this lesson, as well as for your unit test. So today we're going to be talking about taxes, and more specifically, we're really going to focus on federal taxes. So what are taxes and why are they necessary? Obviously, nobody really enjoys paying taxes, but they are a necessity to help our government to run. So taxes are defined as a mandatory payment to a government. That could be a national government, a state government, or a local government. And we see all three of those within our system. And so each level of the government has the ability to tax. That is part of their federal powers that they share, also called concurrent powers. And they do that for the purpose of revenue. Revenue is government income from taxes and other sources. And we'll talk about those other sources in a minute. But taxes are used for a variety of things. Oftentimes taxes are used for things like roads, bridges, street lighting, law enforcement, court systems, schools, etc. And so, like I said before, as much as we may not enjoy paying those taxes, oftentimes we do enjoy the benefits of the services provided through paying those taxes. Okay, so there are a few principles of taxation, and we're going to talk first about the benefits received principle. The benefits received principle says that people who benefit directly from public goods should pay for them in proportion to the amount of benefits received. And so the example here of a benefits received principle or benefits received tax is gasoline. And so whenever a driver goes to a gas pump, they pay additional taxes for that gas. And those taxes are then used for things like road repairs. Now, the taxes only affect the driver. They do not affect everybody in the community. And they are paying for something that impacts the driver directly. So making sure that those roads are in good condition to be able to drive on. So like I said before, the benefit directly from the public goods the people who benefit directly from the public goods pay for the benefits they receive. The second principle we're going to talk about is ability to pay principle. This states that people should be taxed on their ability to pay, no matter the level of benefits they receive. And the example here is that people with higher incomes will pay more than people with lower incomes. And so the people with higher incomes may not receive some of the benefits that their taxes go towards, but they still pay more than those who might be receiving the benefits, which would be the people with the lower incomes. All right, so there's three criteria for taxation. Tax systems attempt to meet the three criteria: equity, simplicity, and efficiency. However, the criteria are sometimes in conflict, and a given tax may not meet all of the criteria equally well. Okay, so the first criteria is equity. Equity or fairness of a tax is established by how uniformly the tax is applied. Equity requires that people in similar situations pay a similar amount of taxes. So an example of this is everyone who buys gasoline pays the same tax, or all people with the same level of income pay the same amount of taxes. So in addition, some people believe that equity requires that people with higher incomes pay more than people with lower incomes. So equity is fairness. The second criteria is simplicity. So the simplicity of a tax is determined by how easy it is for the taxpayer to understand and how easy it is for the government to collect. And so this is very important because it has to be a simple process for us to pay the taxes, because then more people would have excuses to not pay taxes and the inability to pay those taxes if it's too complex. In addition, there should be no confusion about the time the tax is due and the amount to be paid. The sales tax, which we'll talk about in a little while meets the criterion of simplicity. So a percentage of the price of a taxed item is collected every time that item is purchased. So that's pretty simple. You go to the store, if it's a 10% tax, that's pretty simple to calculate or understand why that's already added on to that. And the nice thing is that the cash register does that for you. You don't have to do that math in your head. They automatically spit out that number once you ring everything up. And the third criteria is efficiency. The efficiency of a tax can be judged by how well the tax achieves the goal of raising revenue for the government with the least cost in terms of administration. From a taxpayer's viewpoint, tax efficiency can be judged by the amount of effort and expense it takes to pay the tax. Of all the types of taxes levied, the individual income tax, which we'll also learn about in a few minutes, best meets the criterion of efficiency. Okay, so now we're going to shift gears a bit to talk about tax bases and structures. A tax base is a form of wealth, such as income, property, goods, or services, and all of these things can be taxed. So we've talked about income taxes. Every time that somebody gets paid, taxes are usually already reduced from that paycheck to go towards the federal government, state government, or local government. Property taxes, this is an annual tax placed on property owned by a person. Goods or services, again, that would be sales tax and things like that. So let's talk about the tax bases themselves. So there are 4 types of tax bases. The first is individual income tax. We just kind of spoke about this, based on an individual's income from all sources. And so people are responsible for paying income taxes throughout the year and then filing those taxes at the end of the year. If somebody has paid too many taxes, then oftentimes they might receive money back, or if they have deductions, meaning excuses by the government to maybe have paid less taxes that year, they would have a reduced amount of taxes that they have to pay, or would get more money in return. So, for example, children are considered a tax deduction, and so that would be a reason why the government would say, okay, you know, you shouldn't have to pay as many taxes this year because you have children. Or if you are in college and paying on student loans, again, that might be a reason that the government kind of allows you to pay fewer taxes, so called a tax deduction. The second tax base is corporate income tax, which is based on a corporation's profits. And we don't talk a whole lot about this, but you do need to know that, you know, businesses, especially large businesses, do receive or do have to pay taxes based on how much they earn. The third base here is a sales tax based on the value of goods or services at the time of the sale. You go to the store, they add a certain percentage to the cost or the price of that item, and you automatically pay it up front. It's not something that you generally would pay later. And then finally, property tax based on the value of an individual's or business's assets. Usually when we talk about property tax, we're talking about, you know, the actual physical location of a business or a home, but property tax may also be imposed on other assets such as automobiles. So whenever someone gets their car tag renewed, that would be considered a property tax. Next, we're going to talk about tax structures. Every state determines its own tax structure. So we're going to talk about the different types and how popular they are among states. So the first tax structure we're going to talk about is proportional tax. This is the idea that all taxpayers should have to pay the same percentage in taxes regardless of income. So whether or not you make $2 million a year or $20,000 a year, the percentage of that income would be the same. So if it's 10%, the amount of taxes would be different, but it would be based on the percentage of that income. And that is popular in some states. Some states do use a proportional tax system and charge everyone the same percentage regardless of income. The second and most popular tax structure is the progressive tax. This places a higher percentage rate of taxation on high-income people, with the idea that maybe they have a bit more of a disposable income. They don't necessarily have to have as much of that income to survive, and so therefore some states feel it is necessary to put the higher taxes onto higher income people, and then as you progress lower and lower into the lower income brackets, that percentage also decreases in that progressive tax. And finally, the third, which is the least popular of the tax structures, is the regressive tax. Here it takes a larger percentage of income from low income people, and the few states that do have a regressive tax system, they try to support that argument by saying that the low-income people would be more likely to receive the benefits from those taxes, and therefore that is why they charge them at a higher percentage. All right, so now we're going to talk about the impact of taxes on the economy. Taxes do more than provide government with the revenue that allows it to provide public goods and other programs. Taxes have an economic impact on resource allocation, productivity and growth, and the economic behavior of individuals and businesses. Government chooses what to tax and how to tax based on the amount of income it wants to raise and other economic effects it wants to achieve. So the first impact we're going to talk about is resource allocation. This is who covers the extra cost, the producer or the consumer. So a tax is placed on a good or service will increase the cost of production and therefore shift the supply curve to the left. If the demand remains the same, the price of the good or service will go up. This shift will likely result in a shift in resources. So for example, if the government imposed a 10% tax on luxury yachts, which have elastic demand, the producer of the yachts would not be able to raise prices enough to cover the full cost of the tax. If it were no longer profitable to sell the yachts because of the extra cost of the tax, the producer might decide to shift resources to producing small fishing boats or go into a different business. The second impact we're going to talk about is productivity and growth. When taxes on interest and dividends are high, people tend to save less than when taxes on this source of income are low. And that's typically because they have to pay more taxes. Taxes also have an impact on the amount of money available to producers to invest in their businesses. And some economists also believe that high taxes reduce incentives to work. They suggest that people may spend more time on activities other than work if a large percentage of their income goes to taxes. Okay, and then the third one is economic behavior, tax incentives and sin taxes. And we've talked a little bit about sin taxes before. A tax incentive is the use of taxes to encourage or discourage certain economic behaviors. By providing tax credits or rebates, the government may encourage behavior that is believed to be good for the economy or society. And the opposite could happen with sin taxes. So sin taxes are to discourage unhealthy or damaging behaviors to society, such as gambling, alcohol, and cigarettes. These taxes are generally levied on products or activities for which there is relatively inelastic demand, so that the incidence of the tax will fall on the consumer.